Ted, always great to see you. So maybe starting high level, Ted. We look at the tech sector, the AI trade and trend, as you know here, big winner in 2025. I guess now what, Ted? What do we expect in 2026? What do you think risk reward looks like, given where valuations are at?
Well, Josh, Happy New Year, by the way, and thanks for having me. You asked the right question, and right now I think if you look at 26, we're going to have a tremendous amount of volatility. The AI trade is very well understood, at least through my client base. You look at the infrastructure build really outpacing enterprise adoption, and that's the issue. We're going to spend at a 40% clip here for the next couple years. The SOX is up, the semiconductor index is up almost 48% year to date. And if you look at the IGV or the software index, that's been the big laggard, only up 7.8%. So all I think of this is understood. As we look into 26, there's three issues that I'm looking at very, very closely, and we can go into that if you'd like to.
Yeah, I'd like to go into that. And maybe, Ted, on that point you just brought up, I just want to drill into that. This mismatch, as you say, between the data center build out and the real enterprise AI adoption. When would you expect, Ted, then to see that enterprise AI adoption story play out? Is that a 2026 story, Ted? Is it 2027? What do you think?
Right now, it's hard to nail down, but I don't think it's 26. The enterprise, there's only roughly 30% of the global 2000 that's ready to move to Gen AI. 70% is still going through data cloud migration and data cleansing to get into an LLM. So we've got, enterprise, it always takes so much longer than the street is looking at. That mismatch probably goes into 27, 28 is my guess.
And what are the signs and signals, Ted, as investors I would be looking for to say, okay, now we're really seeing AI monetization, not just AI marketing? I mean, am I looking at software spend? Am I watching the cloud businesses? Like, what should I be looking for, Ted?
I think it's well understood that the cloud titans are going to see it in token growth as well as just their overall cloud growth. Where I think it's really instrumental to see enterprise adoption is via your last few guests is in the software area, specifically on the agentic plays, whether it be a CRM, a ServiceNow, a HubSpot, and then the whole security sector is moving to AI. I think if you see robust net new ARR, that's going to be a very good indication of enterprise adoption.
Another theme, Ted, I want your take on, what you wrote about, was obviously the massive capex by tech giants. But of course, we've seen these concerns creeping up, at least with some names, Ted, financial stress, debt loads. And I'm just curious how you're thinking through that dynamic.
Well, my clients do not want to play names that are negative free cash flow. This is one of these cycles. Because of this mismatch in infrastructure, it's very capital intensive on this infrastructure build. So the only real names that really have the businesses behind it to really fund the capex is Microsoft and Google, and that Google's up 87% year to date. So with that, I think there's a propensity to just watch and have some dry powder. I don't have a lot of interest in some of the negative free cash flow names at this point. And it's obvious, I think, as we go forward that you're getting indications that whether it be Anthropic or whether it be OpenAI or SpaceX, that the debt market is tapped and it's not big enough, quite frankly, to fund the infrastructure build. So all of these next generation companies are going to have to tap the equity market. And my worry there is very simple. After doing this for a few decades, is when you have 4 or 5 major tech companies that have to raise just a boatload of capital, OpenAI has been rumored $100 billion. My worry is that we get some time in 26 where all these guys come public at the same time and we drain, quote unquote, the equity liquidity lake, if you will. And my PMs are going to be forced to sell some of their winners to fund some of these positions in these new companies.
Another theme you call out, Ted, rising component costs, memory, networking. How concerned should investors be about that, Ted? What could that ultimately mean for margins, for end demand?
That's that's $1 million question right there. I think it's under everybody's radar screen. I listen to over 700 or 70 conference calls during an earning season and try to stitch together tech. And for some reason, this is under the radar screen of most. And if you look at the Micron report last week, DRAM, which is really the high performance bandwidth memory that goes into data centers, that ASP, their ASPs were up 20% sequentially for DRAM last quarter. That's a lot of pricing leverage, but in my career, I've not seen ASPs up this amount. Then you listen to the Dell call, and a lot of people are not out of their silos. They need to look at tech from a broad sector standpoint. The CEO of Dell basically, in a nutshell, said, I've got enough components for Q4, but I'm going to see shortages and I'm going to have to raise prices because of components. I think where the street really needs to now focus on is names like in the PC supply chain and the handset area. They're just not going to be able to get a lot of required memory for their products because the AI spend is so dramatic. Now, with these prices up, I think you're going to see a lot of elasticity of demand.
Finally, Ted, I want to just switch gears here hard. But given your background, Naval Academy, naval aviator, Ted, I thought of you when I saw this. I just wanted your take on this news. Chinese government sanctions 20 U.S. defense companies. And apparently, Ted, this is retaliation for Trump's, I guess, approval of weapon sales to Taiwan. I'm just curious, given the background, what do you make of that headline? I mean, American defense contractors not doing a ton of business, of course, in China. So what do you make of it? What was the point and purpose of that, do you think, by Beijing?
Well, the street discounts the whole geopolitical area, which is really a red herring going forward into 26. If you look at the China and U.S. relationship, if you don't get AI right, you're gonna risk your economic development and defense. The defense area is all pivoting, whether it be drones or related AI weaponry. The defense budgets are shifting very, very quickly on a dime to AI. So when we look at this sanctioning on both sides on entities that they view as competitive, this is really economic warfare at its best. And it's discounted. It hasn't mattered in years, but it's going, as we really go on a collision course with the overall China economic and defense standpoint, I think it's going to become much more of an issue in 26 and 27 if it gets out of hand and we don't go back to kind of this mutual assurance on the trade side. Unless we can find a happy medium, we're going to be entering some kind of new Cold War.
Ted, we're always so lucky to have you on the show. Happy holidays, my friend.
Yeah, Happy New Year.